Hello, Matt Bannon here of Granite Point Tax Group, and we get a lot of questions about entity selection. What kind of entity should my business be? Sole proprietorship? What's an LLC? Should I be an S Corp? Things like that. Now, before we really even get started here, I need to make it clear that your choice of business entity really is more of a legal question than a tax question, but there are tax impacts here, so that's what we're going to talk about. So if you start a business, let's say I start a business, it's just me, Matt Bannon, doing my thing, I'd be a sole proprietor, and I would report all my income and expenses on Schedule C of my personal tax return, and that's about it. I'd be fully liable for all my actions, but it's a very simple, clean form of business. And I can always get what's called a DBA, doing business as, so I could still be Matt Bannon doing business as Granite Point Tax Guy. Now, if I partner up with someone, like my partner Garth Gallion, now it's Matt and Garth doing our thing. Now we're a partnership. Now, partnership files its own tax return, Form 1065. There's no tax to pay on a partnership return. It's just reporting all the activity of the partnership, the income, the expenses, and then it issues what's called a K-1. It's kind of like a W-2 for each partner. It says, here's your share of the year's income and expenses and deductions and whatnot. And then each partner reports that on their own personal tax return and pays taxes there. So tax-wise, a partnership is very similar to sole proprietorship. It's kind of like a bunch of sole proprietorships all put together. Then we have the corporation. Now, corporation is a different horse. With a corporation, you're actually creating a separate legal entity, and that the purpose of that entity is to make money running that business, and then it being the corporation, it'll hire you as an employee of the corporation. So now you may own the corporation, but as you are performing services, you're doing that as an employee of the corporation. So you'll get a W-2 at the end of the year, tax withholdings, all that. If there's any profit left over after your salary and the salaries of other employees and all the expenses and everything, then the corporation pays its own tax on that. And any cash left over, it can distribute out to the owners, which could be you or any number of people, and that would come out. That would come out in the form of a dividend. And then you would pay tax on the dividend on your tax return, personal return. Then there's the S corporation. Now, the S corp is so you start with a corporation, and then you can elect, if you are a small corporation, you can elect S status, small corporation. What this does is changes the way the corporation is taxed. Instead of the corporation paying tax, all the income and expenses flow through the corporation out to the owners, similar to the way a partnership works. But you still are an employee of the corporation. So you are on salary, working for the corporation, and then anything left can be distributed out to you as distributions. But that profit that's left after all the expenses will flow out on a K-1 to your personal tax return, and you pay taxes on it there. Then we have the real the wild one, the LLC. A lot of people are really confused about what an LLC is, and that's understandable because from a tax standpoint, there really is no such thing as an LLC. The federal government doesn't even recognize an LLC because an LLC is a limited liability company set up under the laws of whatever state it's set up in. So it's just a state legal classification that grants the company protection from liability. So whatever assets are in the LLC, those are the pool that can be potentially sued for. If something terrible happens in the LLC, somebody sues, they are generally limited to the assets of the LLC. That's the idea. It can be pierced, but that's what the LLC is for. Now, the interesting thing is the LLC then is just this shield or umbrella placed over top some other business entity. So a sole proprietorship can elect to be an LLC, a partnership can be an LLC, even a corporation can be an LLC. It's not a tax entity in itself. So that pretty much covers the different types of entities. Now, why you would choose one over the other, that's a big topic, but generally you're going to go with sole proprietorship or partnership for simplicity and or flexibility. You can add or subtract people, shift things around very easily. Corporations are very structured. It's however many shares you own, that's just your cut. It's very difficult to move income from one owner to the other. You can really only do it through salary or percentage of ownership of the shares. The LLC, really, I would highly recommend you speak with a business attorney about whether you should be an LLC or a corporation, because that's really, the LLC doesn't really have a tax ramification. It's more of a legal question. Then the question of whether to be a C Corp or an S Corp, usually that's going to be a question of whether you want to have great benefits. A C corporation, you can deduct all kinds of benefits to the owners, health insurance, and all the fringe benefits are deductible on a C corp. Whereas an S corp, the owners generally don't get those deductions, but then the corporation doesn't pay income tax. So pluses and minuses either way. Big subject. Give us a call, 503-208-3736, and thanks for tuning in.